Whoa, hold on to your wallets, folks. Things in the global economy just got spicy. We're talking about tariffs on goods from China, potentially hitting a jaw-dropping 245%. Yeah, you heard that right. That means something costing $1 here could theoretically cost almost $3.50 over there if these tariffs went fully into effect on everything. Now, let's be clear. The importer in the U.S. pays the tariff, which usually gets passed on to us, the consumers. So that $100 gadget you love? Suddenly, it might feel like $345 at the checkout. We've seen these trade tensions ramp up for years. It felt like we went from a little trade skirmish to a full-blown economic showdown. It almost feels like we're just a step away from someone yelling, "Infinite tariffs! Let's just stop trading altogether." China's official response has often been like, "Yeah, whatever, your tariffs don't scare us." But come on, last year alone, the U.S. imported over $438 billion worth of stuff from China. Think about everything from electronics to clothes to furniture. Slapping potentially massive tariffs on that? It absolutely makes a difference. When costs potentially triple, businesses freak out, investors panic, markets get shaky, and everyone starts whispering the dreaded I word, inflation. That's a big reason why the stock market has been doing this weird sideways dance lately and why interest rates in the bond market are creeping up. But the craziest development, the rumor mill, is churning about President Trump potentially wanting to fire the chairman of the Federal Reserve, Jerome Powell. Firing the Fed chair? That's like trying to swap out the referee mid-game in the Super Bowl because you don't like their calls. It's basically unheard of and could throw massive uncertainty into the markets. No wonder Wall Street is spooked. And China isn't just sitting back. They're strategically pulling money out of certain U.S. investments, trying to isolate the U.S. financially. On top of that, there are even whispers, just rumors for now, mind you, of the U.S. potentially issuing something called a super bond, a bond you pay back in 100 years. So what started as a trade spat has morphed into something much bigger. We're talking an economic war, a tech war, bond market chaos, and maybe even a central bank crisis brewing. If you're feeling like everything is interconnected and maybe a little bit broken right now, you're not crazy. Hey everyone, this is Wealth Investopia. Welcome back. Or if you're new here, hit that subscribe button because we unravel this complex world of finance together. Today, I want to break down this next phase, explain why it's all happening, and share what I'm personally thinking about with my own money while this whole system seems to be resetting itself in real time. Okay, let's try to make sense of this. There's so much noise, so much conflicting information. Nobody has a perfect crystal ball. But to understand the strategy potentially at play, let me show you a little something from the world of magic. In magic, there's a powerful technique called equivoque, or magician's choice. It sounds fancy, but it basically means I give you a choice that feels totally free, but secretly, I'm guiding you exactly where I want you to go. Imagine I have two cards, red and black. I might say, point to one. If you point to the red one, I say, great, we'll use the red one. If you point to the black one, I say, okay, we'll get rid of the black one, and we still end up using the red one. See? You felt like you had a choice, but the outcome was predetermined by me. Now, here's where it gets really clever. Magicians also use something called multiple outs. This means, because you, the audience, don't know the exact intended ending of the trick, the magician can have several different possible endings planned. So, if plan A goes slightly wrong, the magician smoothly pivots to plan B or plan C, and you still think it was amazing. Maybe the card wasn't supposed to turn blue. Maybe it was supposed to end up in my wallet. I know if I messed up, but you don't. It still looks like magic. Okay, why the magic lesson? Because when I look at the complex situation the U.S. government is navigating, the economy, geopolitics, debt, it feels a bit like they're using equivoque and multiple outs. There seems to be one main desired outcome, the big reveal they're aiming for. People debate what it is, but looking at the clues, I think the primary goal is lower interest rates. Why? Two massive reasons. The U.S. has a mountain of national debt, a staggering amount, and needs refinancing relatively soon. If interest rates stay high, paying the interest on that debt becomes astronomically expensive, potentially crowding out other essential spending or forcing even more borrowing. Think about refinancing your house at 8% versus 3%. It's a huge difference. Lower rates also stimulate the economy. Cheaper mortgages, cheaper car loans, businesses borrowing to expand. It gets the economic engine humming again, which everyone, including the government, generally likes. Now, navigating this high-rate environment as an investor can be tricky. You need options and clarity. With a good trading firm, you can earn a competitive yield on your uninvested cash, around 5.1% APY with no fees or minimums on that feature. With good diversified portfolios of corporate bonds, potentially yielding 7% or higher, with a minimum investment of just $1,000. Normally, accessing something like that requires much more capital, okay? So the main goal seems to be lower interest rates. But unlike a simple card trick, the economy is messy. Geopolitics, inflation, market psychology, it's complicated. So the government needs those multiple outs, several backup plans or alternative objectives that can still be framed as a win. What might these outs look like? Outcome A. Fair trade win. Use tariffs as leverage. Pressure China and other countries to lower their barriers, leading to fairer trade deals and maybe boosting U.S. exports. Checkmark appears. That's better than the status quo. Outcome B. Bring jobs home. Use tariffs to make importing expensive, encouraging companies to manufacture critical goods, like semiconductors, pharmaceuticals, back in the U.S. Strengthens national security, creates high-skilled jobs. Check mark appears. Another win. Outcome C. Isolate China. Use tariffs and diplomacy to pressure allies to reduce their reliance on China, effectively squeezing China's economic influence and closing loopholes around tariffs. Helps the U.S. trade balance. Check mark appears. Still a positive outcome. Outcome D. Inflation. Defeated. If the economy slows down because of all this chaos or even high rates, point to falling inflation. See, gas prices are down, egg prices are stable. We made things more affordable for you. Checkmark appears. A win for consumers, politically useful. Right now, though, what we're seeing is the bond market sending interest rates up, especially longer-term ones. That's the opposite of the main goal. It's like the audience is watching the trick and thinking, buddy, I think you messed up. But the show isn't over yet. The magician might just be setting up the next phase. And this is where the Fed drama and the super bond idea come back into play. They are potential levers to pull to get back on track towards lower rates. The pressure on the Fed chair, Jerome Powell, is immense. President Trump has been very vocal, basically saying Powell isn't cutting rates fast enough. He even said Powell's termination cannot come fast enough. Historically, firing a Fed chair just because you disagree with their interest rate policy, it's never happened. The Fed is supposed to be independent to avoid political meddling messing with the economy long term. Legally, Powell's term runs until 2026, and he can only be removed for cause, meaning serious misconduct, not just because the president wants 0% interest rates now. But that hasn't stopped speculation about workarounds, maybe reassigning him, appointing a shadow Fed chair to publicly contradict him. It's high-stakes political maneuvering aimed squarely at getting those rates down one way or another. And then there's the superbond concept. Imagine the U.S. government issuing bonds that don't have to be paid back for 100 years until 2125. It's the ultimate kick the can down the road, letting future generations deal with today's debt. The clever part? The government would likely retain the option to repay these bonds early if interest rates fall significantly in the future. So they could potentially lock in today's higher rate, which isn't ideal, but hope to refinance it cheaply decades from now. The big question, of course, is who would buy a 100-year IOU from the U.S. right now with all this uncertainty? Probably a tough sell, but it shows the kind of unconventional thinking happening to manage the debt situation. It all points back to needing cheaper ways to borrow. So while these big strategic magic tricks are potentially playing out behind the scenes, what are we, the audience, actually experiencing right now? Market turmoil. We've seen some brutal days in the stock market recently. The S&P 500 had massive drops. Tech giants like Nvidia lost billions in value in mere days. The VIX, Wall Street's fear gauge, spiked into panic territory. That signals real anxiety among investors. And the bond market, usually the calm, boring sibling of the stock market, is acting weirdly. Short-term borrowing costs are hinting the Fed might have to cut rates soon due to economic stress. But long-term borrowing costs, like the 10-year Treasury, are rising. Why? Because investors are demanding extra payment not just for inflation, but for uncertainty. Uncertainty about the Fed's independence, about trade wars, about global stability, about whether countries like China or Japan might start dumping U.S. debt. This isn't just a U.S. story. Europe is facing its own slowdowns. Germany is flirting with recession. The European Central Bank has already started cutting rates. It's a global economic pressure cooker. Ironically, even with all the U.S. drama in times of global chaos, money often flees towards perceived safety. Right now, that looks like the U.S. dollar, gold, and short-term U.S. government bonds. It's a strange paradox. So yeah, it feels like we're watching a performance where cards are being dropped, smoke is filling the stage, and everyone's whispering, "Was that supposed to happen?" But here's how I'm trying to think about it, drawing from my interest in this stuff. Remember the magic trick? The audience doesn't always know the real trick until the final reveal. Sometimes the chaos is the misdirection. So what am I doing with my own money amidst this? And let me be super clear. This is not financial advice. This is just me sharing my personal thought process and long-term strategy. Please do your own research and consult with a professional. 1. Staying consistent. I'm continuing to dollar-cost average into broad market index funds, like VTI, which represents the total U.S. stock market. My belief is that over the long term, think decades, the market tends to go up. Volatility and drops? Honestly, I see them as opportunities to buy more shares at a discount. I'm playing the long game. 2. Considering alternatives. I also continue to allocate a small portion of my portfolio to Bitcoin. Why? If traditional money systems are facing this much pressure and potential manipulation, the illusion we discussed, I see Bitcoin as a potential hedge, a decentralized system that, in theory, can't be controlled or easily inflated by a single entity. 3. Security. Any crypto I do hold, I prioritize moving off exchanges into secure cold storage. Control your keys, control your coins. Optional. Briefly mention your course again if applicable. Look, I don't have a crystal ball. I don't know exactly how this global economic magic show will end. And frankly, I don't think the politicians or central bankers know the exact outcome either. That's the whole point of the multiple outs strategy. Have several acceptable paths forward because the world is unpredictable. Will the Fed be forced to cut rates dramatically? Will the super bond ever become a reality? Will tariffs reshape global trade permanently? We'll have to watch and see. Be a good audience member. Stay calm, keep watching, and maybe even learn something entertaining along the way. But that's just my take. I'd love to hear your thoughts. What do you think is the main goal here? How are you navigating these choppy waters? Let me know down in the comments. If you found this breakdown helpful or interesting, please give that like button a quick smash. It really helps the channel. And if you haven't already, subscribe and hit the notification bell so you don't miss our next deep dive. Thanks so much for watching. Stay curious, stay informed, and I'll see you in the next video.